Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Rebecca Corbin. She's the founder and CEO of Corbin Advisors. We're going to take a look at how executives and stakeholders can maintain investor confidence. This is what investors expect from management teams. Rebecca, it's great to have you back with me on Trade Talks. Thank you so much for joining. And let's take a look at your first slide here, talking about the most significant economic impacts.
Absolutely. We surveyed investors globally, 89 investors globally across all sectors. Over 60% are generalists. And heading into the first quarter, no big surprises here. Really looking for very downbeat earnings. I do want to highlight that investors were thinking a lot about Q1 results, and many companies in North America and other parts of the world outside of China really didn't see impact until the back half of March, meaning that we've seen quite a bit of positive surprises. So if we just look at the S&P 500 company results, 60% have actually reported a positive EPS surprise, still below the 5-year average, but still above the consensus. And that's really part and parcel. I think what really is of focus is 2Q. And that's really where we have a lot of uncertainty given the number of guidance withdrawals we've been seeing.
Right. And moving along here, investors are really looking for decisive actions from management teams. Tell us more about that.
Sure. First of all, number one is balance sheet strengthening and liquidity preservation. And companies really need to be focused on that, have been focused on that. We've seen a tremendous amount of press releases, 8Ks, announcements with regard to liquidity, revolvers, negotiating contingencies on those revolvers. And so that's front and center. Truly, what is the total liquidity of the company in terms of credit facilities plus cash on hand? Related to that is really cash. What are they doing to preserve cash, to really drive cash flow? And that gets into the level of detail that best-in-class companies are providing, which is specific actions taken around cost management. And we've seen a plethora of that activity, including furloughs, management and board compensation reductions, deferrals of 401k matches, cancellations of merit increases. And so companies are taking very significant action with regard to not necessarily sustainable cost cuts, but cost cuts in the near term that are going to help preserve cash. And for the companies that are harder hit in those industries, such as travel, airlines, et cetera, we're seeing fairly drastic actions with regard to dividend suspensions and reductions. And mainly in the oil and gas, we've seen more reductions than other sectors.
What are they looking in terms of what the recovery will look like? There's so many L-shape, V-shape, U-shape. From the people who responded, what do they think is going to be most likely?
So it is interesting. When we launched the survey, the views did change throughout the time period, and it was generally open for about a month, mid-March to mid-April. And so it started with a V and it ended up a U. And I think that there is an actual disconnect in the sense that when we conducted the survey, based on what investors were expecting with regard to the contraction in GDP, which was around 2%, 2.7%, definitely thinking about a back half recovery of some sort. And I think now that we've had a lot of earnings announcements and a lot of uncertainty with increasing number of withdrawals, I think it's clear that this is going to be a lot longer than investors expected heading into earnings season. And, I believe that we'll probably have some sort of a modified U. I don't think it'll go straight up. I think it'll be a little bit more of a gradual up. And, there's still a lot of activity that has to play out with regard to the impact from COVID-19, folks without jobs globally, and the sheltering. And that's the big question. The big question is, what does the demand curve look like? And the question is whether the consumer, which was the juggernaut of the economy heading into this, even though we were starting to see, weakening industrial production, et cetera, the consumer is still very strong. And the big question on everybody's minds is, what is the consumer behavior going to be when the government sheltering bans are lifted?
All right, and let's wrap up right there with earnings results and, of course, guidance, because, again, it comes all back to consumer spend, 70% of our GDP. As you had mentioned, that really was the story in 2019 and where the strength was coming from. And I think guidance is going to matter more than ever now.
Absolutely. And so if we look at the S&P 500, and we've been tracking this daily, 53% of the S&P 500 has essentially withdrawn their guidance, whether it was annual, and quarterly. A very small portion has moved from providing annual to now initiating quarterly. And I will tell you that in lieu of guidance, companies have been very transparent, at least the ones that we've been tracking, and they've provided scenario analyses. They have provided, based on inputs and drivers to their business and looking at cash flow and decremental margins. They have provided real-time information through April in terms of order trends and backlog and customer demand behavior. So there is a lot of insight out there with regard to trends, although for the full year, that has essentially been largely removed from the picture. And, at the end of the day, companies should be providing as much transparency to investors around how to evaluate their business so that investors have an understanding of the guardrails. Generally speaking, they are skeptics looking at risk. And so we certainly don't want them making a misperception about how our business is going to behave to the negative side. And we will continue to see companies provide, I think, more near-term guidance until there's greater visibility with regard to what this impact is going to be. Clearly, second quarter is going to be a very negative quarter. We've seen ranges anywhere from, on average, down 25% to 50%.
All right, Rebecca, great insight as always. Thank you so much for joining us on Trade Talks.
Thanks so much, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.